tech companies, So I think during COVID, we've seen a lot of these companies go up multifold, obviously because interest rates were low, funding was easy. So a lot of these companies went up without any fundamentals, So I think that is one space that I am not that confident that it could bounce back or there's some pain left there. But on the other side, there's the mature tech, which is your Googles, Facebooks, Microsoft, Amazons, the bigger companies, which you can, they do have fundamentals, they are profitable, they are growing well. And if you've seen over the last 20 years, 20-30% fall in tech stocks is not that uncommon. So we are not perturbed about the mature tech space. In fact, they provide a good entry point right now. So I would differentiate between the two. I'm not too confident about the new age tech, but I'm very confident about the mature tech.
All right. Prateek, what do you say?
Yeah. Firstly, thanks, PT, for having me out here. In terms of, I think tech stocks or investing in US or, outside of India, I think just to take a step back, a little bit, I used to be a wealth manager in the US in San Francisco in 2018. And I had about 800 to 900 customers. All of them were 25 plus million in assets. So all ultra HNI types. And when I saw their portfolios, approximately 15 to 20% of their portfolios were invested outside their home country, which is outside the US. And I saw a similar trend of portfolios in the UK, in Europe, and also in Southeast Asia. And when I came back to India in 2018, I saw that no one was really investing outside. So I think it's important, yes, and one of the key differences to why I think investing international has worked well in the last, say, 5 to 10 years' time is because of, ideally diversification. What essentially investors gain by sort of, having some of their portfolio outside their home country is that what we've seen is markets in the US and markets in India or international markets versus Indian markets move in very different directions. And that provides a lot of flexibility and a lot of diversification in your portfolio. What we've also seen is that international diversification is the only such asset class that actually not only sort of gives you the same returns as what you would have in India, but also really leads to a much better sort of portfolio in terms of diversification, which is what we saw last year as well. The fact that Indian markets were resilient and the US markets weren't shows that diversification just play out really well. And obviously the idea is to really ensure that some of your money is diversified, and that's essentially where I think investing in international comes in. When it comes to tech stocks, I sort of agree with Neil out here. I think if you compare, say, last year with, say, the crisis that happened in '99, where there was an entire tech rout, back then you had a lot of these companies who were growing fast, but their balance sheet and P&Ls were quite weak. If you see last year, or if you see the current status of tech, these guys are absolutely cash flowing machines. They make a lot of money. Their cash flows are very strong. I think what we've seen, which is a positive trend that happened last year, is that the expectations have come down, which is actually great because, all of these companies who are valued at trillions of dollars were still being expected to grow at 50-60% CAGR. So I think, now that we have some normalcy in the markets, and also their business models have not been impacted at all. In fact, they've become stronger since we've seen post-COVID. And I think, the entire tech revolution is still, year to unfold. And it's going to obviously impact a lot more markets in the future than we have. So I do think that, obviously, investing internationally is great in terms of diversification. I do think that, most people would not really understand how to diversify, which is why I think mutual funds make a lot more sense for investors.
Okay, so fair point. I mean, you talk about diversifying into investing internationally, but of course, anything anyone thinks about is tech and Wall Street. So I want to get an understanding of, when you are investing, beyond the Indian horizon, what are investors asking for? I mean, are they literally just asking for FANG stocks, or are they also looking beyond? And secondly, when you say that expectations have moderated, have they really? Because we're looking at a 80% drop or a 50% drop coming in on some of these big names.
Yeah, so I think for the return part of it, I think we've been spoiled. I think last few years, I think we all have been spoiled for good returns. I think the expectations are still high. I think we've not seen a bear market for a while, and the newer investors who've come, and a lot of them have come in the last 4 or 5 years. They've not seen an elongated bear market, and that's what worries me. The worry is that the expectations are a bit high still, and I am not sure that, the last 2 years or before this year, the previous 2 or 3 years was great run, we got 30, 40% kind of returns, on a yearly basis, but that spoiled a lot of people. I think return moderation, it will happen. I think some people will learn it the hard way, that, getting 12, 13, 14% return is great actually from equities, I don't think you should expect anything. Sometimes now I see, for the younger lot at least, just expect 20% return, but that's going to be tough to get. Some people will learn it the hard way. Some people will obviously, hopefully we all will educate them and make sure that, the return expectations are maintained, and that equity is a long-term product, we are obsessed with the last 6 months or the last 1 year returns, but we were big proponents, and all of us here in the mutual fund industry, we keep talking about long-term investing, equities, 5+ year investing. But in the end, everything is, we're judged by the last 6 months or the last 1 year, so that is unfortunate. That needs to change. But hopefully, some pain probably would be there. I don't think the next 1-2 years are going to be that great as what we saw in COVID. I think some normalization will come through, So I think, in fact, right now we're in a very normal market. I think that time was a abnormal market where negative interest rates or low interest rates, easy funding, markets just going up. Anything and everything was going up. I think this year or the next 1 or 2 years will be a stock picker's market. You'll have to be really careful of what you pick.
I was just going to ask you that. I said, look, you have all the research, the reports, the analysis, the insight to tell us what makes a good investment when it comes to specific stocks, or even if you're going through a mutual fund, let's say you want to know where your money is going when it comes to some of these names. Where do you see value, or what is attractive to you on foreign shores, and why?
Yeah, so when it comes to, I think investing internationally, there's typically, I would say, 2 ways of why most people invest. One is obviously they want to invest. There is this sexy version of, buying the FANG stocks, Google, Facebook, Netflix, Amazon, which I think is fine if you're taking a very long-term bet on those business models. The second one, as I said, is more on the diversifying nature, where you're looking at, putting in portfolio allocation towards, some of these, at least stocks or mutual funds out there, which I think is also good if you're from a long-term perspective. And there you also have to, have that patience to sort of ride the tech wave or, ride ups and downs. Well, there's typically maybe 2 ways of investing. One is through LRS and the other one is through mutual funds. What we've seen in my experience is that, LRS is a lot more expensive. However, investors who are looking at choice, obviously we don't have a lot of choices here in the mutual fund industry, can look at that space really well. Again, costs have to be monitored, but someone who's looking for something very simple, who's looking for a, excellent portfolio manager, who's looking at, diversifying, can look at mutual funds, or if someone is looking for a simple index fund, they can also do that. So these are the very simple ways of, going about, diversifying, your capital internationally. In terms of, spots of value, I believe that, there is a lot of value today, especially on the basis of what has happened over the last year. For example, someone was talking about China right now. China, I think, has a current P of about 9.5 right now, which is crazy low. Obviously, it comes with a lot of risk involved. You also have, other European countries, Russia, for example, has a P of 2, which is crazy low. So I think value is there, but I do think that investors, especially looking at going abroad, should ideally stay away from doing too much research, because what I've seen in my experience is that the understanding is very less. Today you'll have someone come to you and say that 97% of wealth creation opportunities are outside of India. You should go for it. I can also say that 99% of commercial real estate is outside of India. Will you go buy it? Probably not, right? So I think what's important is investing in something you understand, and which is why I think something simple is a lot more effective for wealth creation than going out there and trying to pick specific markets or pick specific geographies or specific stocks also.
So with the changing environment currently, the changing rate environment and the fact that everyone's predicting doom and gloom, overseas, which may or may not happen, do you feel that there is more of a case to continue to invest in the India story, or as you said earlier, would you suggest perhaps keeping your portfolio diversified, maybe 20-30%, is what Prateek was suggesting, to keep for overseas markets?
Yeah, I think we as Indians, we have a home country bias, which is that we are obviously very attached to our country and we think we know a lot about our country and we're comfortable investing in India. The reason you go abroad to invest is not to get more returns. I think it's to reduce the risk, as Pratik said, that different markets move differently, and that's the beauty of diversification. You want two asset classes to go against each other. That's diversification. There's no point of diversification. Everything moves together, comes down together. So that reduces the portfolio risk. The other thing is, like we said, most of the opportunities, or more than 97-98% of the opportunities, are outside India. So sometimes just looking at 3 or 4% of the world, and we are 3 or 4% of the world market cap. So a lot of the opportunities lie outside India. And thirdly, I would think that a lot of opportunities in the listed space are in the US or in foreign markets. Like for example, there's no equivalent to a Google or a Amazon or something like that in India. We don't have any cloud computing kind of companies, which if you think that's going to be the future and that's the growth prospect, then you have to go outside India. So I don't think you should be searching for alpha abroad, but I think you definitely want to diversify outside India to reduce the risk of the portfolio.
Okay, fair enough. So, give us, you were talking about doing it through mutual funds earlier, Prateek. So give us the best way to go about this, the kind of return expectation, your strategy now for 23, since we've entered a new year. Just give us a holistic view.
Sure. Yeah, I think in terms of, I think in terms of return expectations, that's super important. In fact, small story, in 2021, we'd actually, so we done one of the largest international funds in India that's investing directly in the US, and we actually, sent out 2 or 3 emailers to our clients saying that, you should, lower your expectations when it comes to international investing. There's a lot of, talk and all about it. And on the basis of those emails, the interest in international funds actually went up, not down. So I think it's extremely important for investors to have very lenient expectations. If you look at the last 10 years, you can see great numbers. For example, when you look at 10 years ago, the Nasdaq would have done, I don't know, maybe 20-25% CAGR. But over the last 20 years, it would have done roughly the same as what India has done. So I think in terms of return expectations, it makes sense to have the same return expectations as what you would have in India. But I think what's important is, investors should expect risk to come down dramatically because of, diversification to come in play. So I think that's what we essentially tell investors is, I think maintain your expectations and obviously have a long-term approach. The second thing, and this is what, I was, talking to Neil about, before coming here, is that there's 2 problems, at least, not when it comes to international investing, but investing in general. And that was really that sort of came into the picture in 2022, is that investors have, 2 things that are, sort of not going right for them. One is there's not a lot of sensitivity to pain is a lot less in sort of today's investor profiles than what it used to be, say, 5-10 years ago. So I think whenever an investor sees some, different portfolio not doing well or whatever, they tend to react very quickly. And I think if you ask any investor, successful investor, or even any entrepreneur, sensitivity to pain is extremely important, not only in, success in work, but also success in investing. The second thing, and this is again something which has, led to a lot more speculation, is investing in a lot of these, I wouldn't say fads, but, something keeps happening every year. So you had the US investing, you had, cryptocurrency, you had sector investing. What happens is a lot of investors, tend to overvalue, owning something which is extremely exotic, because it's a lot more interesting. But actually, wealth creation happens in very simple products. I think an investor should ideally, have most of their portfolios in simple products. And obviously, if they are looking at something complex or something which is exciting, that should be a relatively smaller part of their portfolio. And the same with international funds. I think what I've seen is investors who go chase after these, electric vehicle or biotechnology or these sort of thematic funds. It's very exciting to invest in these sort of themes, but actually, wealth is made if you invest in something as simple as an S&P 500 fund or like a simple broad-based mutual fund, and just sort of sticking to, I think consistency is very, very important for investors. And investing in general, I think, remain invested. If you have a thesis of you wanting to, put in 15 to 20% of your portfolio outside, stick to that thesis and, make sure it's there for the portfolio.
Neil? If you want to add to that in terms of, what you're looking at in 2023, in terms of overall strategy, with regards to all the moving forces when it comes to global markets right now.
Okay, so let me try to answer this slightly differently, So a couple of years back or during COVID, somebody asked Jeff Bezos of Amazon that so much is changing. How are you looking at things and how are you looking at change, And he had something very interesting to say. He's like, I am not really focused on what is going to change. I am more focused on what is not going to change. So let's see for Amazon. So he said that for Amazon, what is not going to change? Even 150 years, 100 years from now, what will not change? One is that when people are searching on Amazon, they are looking for the lowest cost product, So my job is to keep making the cost lower and lower. It's not like we go to Amazon and look for the highest, the most expensive product, So cost has to come down. Secondly, people want more and more choices. So his thing is that people are 50 years from now also going to want more and more choices. They're not going to want less choice, for the products they want. They want to compare and they want to contrast. So he's like, it's the second thing I need to do is have more and more choices. Third thing is that people want quick delivery. It's like when you order, he's like, my thing is that how do I make logistics more efficient? How do I make the product go quicker to your place, It's not like when we order food or something, we want it immediately. We're hungry right now, want it after 5 hours or something like that. So he's like, these three things I need to concentrate on: lower cost, more product, and faster delivery. So he's saying that's not going to change ever. So I'm more concerned about those things. When it comes to investing and what are we looking at, so what is not going to change in investing? Partnering with good managements is not going to change. If there's a chore management 100 years back, he's going to swindle you. Today there's a chore management, he's going to swindle you. 100 years from now, chore management is going to swindle you. So partner with great management or good promoters. Secondly, buy low, sell high. Fundamentals matter. So there will be sometimes spikes in sometimes cryptos and all will come, but in the end you need to fundamentals need to be in check. Fundamentals with obviously growth prospects, so that's not going to change. So the way you make money is buying low and selling high, not the other way around. So concentrate on fundamentals, concentrate on good companies. And thirdly, from a business point of view, people when you're dealing with people's money, they want quicker resolution of their queries, or they want faster transactions. So the other thing is, from a business point of view, is obviously try to get your tech in place and make sure that clients are well serviced, and those are the 3-4 things that we would concentrate on.
So, just broadly speaking, throwing it out there, but what are the couple of themes that are really exciting you going forward? I mean, would it be everyone's talking about chat AI, we've got big tech investing in it all over the place. Would it be ESG? Would it be, something I haven't thought of? What would be the one theme that's really exciting you as investors, whether it be, globally, whether it be here or overseas?
So in India, we're actually pretty, we like the banking sector, the financial sector, I think that looks really attractive. Again, PSUs after a long time look slightly attractive. And if we could invest abroad, because right now there is a limit that we can't invest abroad, then we would definitely look at big tech to invest in right now.
Okay, so staying on your radar then.
Yeah, I think in terms of, exciting, and this is where, I think things have flipped over the last, 2 years. There's this two styles of investing, value investing and growth investing. And over the last decade or so, growth investing has been the dominant sort of way of, wealth creation for a lot of investors. What was expensive 10 years ago is even more expensive today. And what was cheap 10 years ago was even more cheap. And what we've seen over the last 2 years is that, investing is actually, there's been a certain shift where a lot of these value companies, the PSU stocks, the energy stocks, the utility stocks, have actually come back in a very big way. So I do believe that in terms of what's exciting, what we've seen uncover over the last 2 years is actually exciting is not as exciting anymore. The non-exciting is the one which is actually, done really well in terms of performance, not only in India, but also in the US. In the US, every single, sector is down from its peak since the early 2022, except energy, which is up 60%. In India as well, if you look at the sector profile, a lot of these, stocks which were labeled junk stocks, say, 2 years ago, have done astronomically well over the last few years. So I do believe that, there has been a certain shift. And in terms of, going forward, it's really hard to say, which sort of camp is actually, going to do well over the next decade.
Interesting. So if you had to diversify within, your pickings in the overseas market, would you be choosing between some of the other sectors? Would you be looking at energy? He's clearly big tech. How would you break it up? I'm just curious.
Yeah. So, as a mutual fund house, when it comes to our international funds, we're purely passive. So, and I think passive makes a lot of sense, even to me, because, I think it makes the selection a lot easier. For investors who are looking to diversify internationally, you don't have to worry about, which stock to buy, which stock to sell. It's coming at you at a very reasonable cost. And it's something which has been there for, half a century. The first S&P 500 fund was launched in the 1970s. Its track record goes back almost 100 years. So I think, I head passive funds at MOAMC. And the reason why I like, investing in passive funds is because mutual fund has simplified stock investing, but passive funds have simplified mutual fund investing. And I think the simplest way to wealth creation for most people ends up becoming the best. So I think, especially when it comes to internationals, because there's, hundreds and thousands and millions of options out there. So I think, and also I think what we've learned over the last 10 years is that information arbitrage is also becoming a lot harder, especially in the West, not yet in India. So I think really keeping it simple is what has become a default and a very good strategy for a lot of investors.
Do you think, Prateek, that we are going to see a recession in the US? What's your call on this?
Yeah, I think in terms of macro fundamentals, what's funny is that, even my reading has been diversified, so I used to read Indian news now, and now I feel like, reading The Economist and FT has become a lot more value accretive because a lot of changes in the West now impact India. But in general, what I've seen is, and this is from my readings, is, when you see interviews of CEOs in Davos, there is this, sort of a lot more, the body language is a lot better from where it was last year. I think in terms of, just simple macros, I think, interest rates have sort of, at least long-term interest rates are now, plateauing, which is great. You have obviously had inflation, which was also, coming down. I think China was a big problem point last year, even that's sort of opening up. And also the global supply chains, which was an issue last year, is also sort of, loosening out. So, and also Europe's energy problem is also going away. So overall, you could see a much better body language from a lot of them from my end. I think and I would say they're in a slightly better position to see what's coming than we are. So I think from that, I could say that we're definitely in a lot better position today than what we anticipated a few months ago.
Okay. And if I had to push you, Neil, and I know you may not want to talk stock specific, but if you had to choose one of the FANG stocks or any of the tech stocks, what would be your favorite and why? Even if it's beaten down today, but you're like betting on it coming back.
Yeah, I think I won't give you one. I'll give you three. Okay. So if I had to buy personally, and I don't know what the fund will do and all, but if me personally, I'd probably buy Google, Microsoft, Amazon.
All right, awesome. all the three big ones. Okay.
What about ChatGPT?
What about
That's too early.
ChatGPT? Oh, it's clearly on everyone's radar. We're going to be hearing about it sooner than later, I think. 10 billion, right? Microsoft just put in.
Yes.
Yeah, it's
So it's not going away anytime soon. Gentlemen, thank you so much for joining us. A big round of applause. And
Thank you.
hope from this conversation that everyone takes away to remain invested somewhat in the overseas markets. Thanks so much.
Thanks. Thanks. Thank you. Thanks.